Ross, first and foremost, just a quick review on the scale of yesterday's bounce following the Fed decision. Was that justified in your eyes?
I think it was. Now, of course, we've seen these bounces on the past couple of Fed days, and they've been very, very quickly given back. I think yesterday felt a little more sustainable. I think coming into the Fed with certain expectations, them meeting those expectations, and I think also setting the table for a potential pivot or softening in policy down the road with some of the language and some of the responses at the presser. I think that's what the market needs to see to get any sort of bounce in risk assets, right? You need to see inflation come down, but you also need to know that the Fed's going to pull off the gas when there are indications that that's happening and that they're going to do everything they can to not put the economy into a 2023 recession. So it was a big move. We might give some of it back today, but I think it was certainly more justified than the big moves we've seen on the last couple of Fed meetings.
And of course, talk, as I just mentioned, of potential more fiscal stimulus as well down the line. Does all of that have to prevent a recession from happening for yesterday's bounce to be justified? Or it doesn't really matter now, even if there is a small recession, as long as you don't see the Fed hiking rates too much more aggressively from here?
I think that's basically it. I mean, when the Fed has made itself such a large player in the market, something as kind of marginal as that type of activity can have a huge impact on risk assets. You know, our base case is that we're probably heading for a mild recession next year. I don't think we're in a recession today. I think what stocks have done across this year is pricing that in pretty well already, you know, down 24% on the S&P 500 at the bottom. That's pricing in a pretty good amount of pain at some point in the next year. I don't think it's what we're feeling right now. But as the Fed continues to raise rates, even if it's at a slower pace into year end, to fight inflation, I think we'll probably hit some sort of slowdown next year. But again, I think it'll be milder given where the consumer is, given where the labor market is, and we'll go from there.
And so do you think that mega cap tech is a buy here? Well, I mean, I guess it's got to be stock specific, but have we seen enough from those companies reporting earnings and from the Fed to start buying those names again?
I think with those names, it's a matter of time horizon. If you're in them for the long term, or at least the intermediate term, I think they're starting to look pretty attractive. I mean, you're talking about names that are really secular growth winners, strong businesses, strong balance sheets. You know, that it might not yet be the environment for them, but these businesses are going to survive through any sort of economic slowdown, recession. They're obviously beating, by and large, estimates this earnings period. And so if you can stomach maybe some more pain in the near term, or at least some more volatility, I think they're going to not necessarily repeat the performance of the past decade, but you can definitely see an environment where we return to slower growth, lower inflation, and you're going to want to own the bring your own growth to the table names. And those are those secular growth winners that are concentrated in sectors like tech, consumer-facing, discretionary, comm services, things of that nature.
Do you avoid the cyclical sectors like banks, for example?
I think near term, you know, banks might be challenged, banks and financials. You know, if you look at the yield curve, if you do anticipate that we're heading into more of a slowdown over the next 12 months, that's going to be a tough space to own. But I think about something like energy, on the other hand. Sure, we're heading into, you know, a potential slowdown, and there might be some demand destruction globally for the energy names. But that's a really strong trend, a group that has been doing really well for the past year. And there's still structural tightness on the supply side there. They're printing money at this point. And I think that could be a name in the cyclical area that might still be something to own. They're spitting out a lot of capital and shareholder return. And that's the kind of thing we want to see in a rising interest rate environment as well.